Hey everyone, welcome back to the deep dive. You know that feeling when you're staring at a dense financial report, wishing someone could just cut through the noise?
And tell you what really matters. What's the story hiding in those figures?
Exactly.
Yeah.
Well, today, that's what we're doing. We're taking a deep dive into ICICI Prudential Life Insurance, specifically their Q1 FY 2026 results for the quarter ending June 30th, 2025.
And we've really gone through the source material here. We've got the earnings call transcript, the detailed financials, their investor presentation too.
Yeah, quite a bit to unpack.
Definitely. And our mission today, to cut through that jargon, understand the core performance, spot the big shifts.
And figure out what these numbers really tell us about their strategy, and maybe the wider life insurance picture, too.
Right. So what does all this mean for you listening in?
We'll break it all down. Actionable insights, hopefully helping you get informed quickly and properly. So let's start with the big picture. What was the economic scene like, the industry context?
Well, the sources point to some definite turbulence in the Indian economy around that time. You had challenges popping up in microfinance, ongoing tariff issues, geopolitical stuff playing out. It all feeds into, equity market volatility.
And that makes people nervous, right? Affects sentiment.
Absolutely. Particularly for discretionary spending. When things feel uncertain, people tend to tighten their belts a bit, save more, spend less on non-essentials.
Okay, and that economic hesitation, did it ripple through the whole life insurance industry?
It seems so. The industry as a whole grew slower in Q1 FY 2026. We're talking 5% year-on-year growth in retail-weighted received premium RWRP.
Only 5%? That sounds low.
It is, especially when you compare it to the year before.
Yeah.
Q1 FY 2025 saw 20% growth. So yeah, a pretty significant slowdown across the board.
So ICICI Prudential was operating in that tougher climate. But you mentioned something else, an internal factor.
Yeah, exactly. On top of the market slowdown, they were up against a really high base from Q1 last year.
The comparison effect.
Right. They had, massive 47% RWRP growth back in Q1 FY 2025. That was fueled by strong linked business markets were doing well then, and also a very successful, unique annuity product they launched.
Okay, so a double whammy, really. External headwinds and a tough internal benchmark.
Pretty much. It sets the stage for why some of their numbers might look the way they do this quarter.
And you mentioned market volatility, shifting preferences.
Definitely. We saw, and the company highlights this, a real surge in demand for non-linked products, guaranteed return type stuff.
Makes sense. People looking for safety.
Yeah, wealth preservation seemed to take priority over, let's say, chasing higher capital appreciation through linked products when the markets are choppy.
But what about protection? Pure life cover.
That held up well. Retail protection actually continued its strong momentum. It's generally less tied to market swings, right? People still need cover regardless of what the equity market is doing.
Right, a fundamental need. Okay, so given that context, tough market, high base, shifting preferences, how did ICICI Pru actually perform? Let's get into the financials for Q1 FY 2026.
Okay, well, first headline number. Profit after tax, or PT, it actually grew quite impressively, 34.2% year-on-year.
Wow, 34%. How do they manage that in a slower market?
Two main drivers mentioned. One was lower new business strain. That's basically the upfront cost hit you take when writing new policies.
Right, before the premiums really start rolling in consistently.
Exactly. So lower strain helped. And the other factor was higher investment income coming from their shareholder investments.
Okay, so profits up strongly. But what about new business generation itself? The value of new business, VNB.
Now that's where it gets interesting. The VNB actually declined slightly by 3.2% year-on-year, coming in at $4.57 billion.
Declined. But profits were up. How does that work?
It's all about the margin. While the total VNB dipped, their VNB margin improved. It went up to 24.5% from 24.0% in Q1 last year, and significantly better than the 22.8% they reported for the full previous financial year.
So they wrote slightly less new business in value terms, but each bit of new business they did write was more profitable.
Precisely. It points towards that shift in product mix we talked about, more non-linked savings, and especially more protection business, which typically carry higher margins.
It sounds like a strategic choice then, focusing on profitability over just sheer volume in a tough market, maybe accepting slightly lower volume growth to get better quality sales.
That seems to be the narrative, yes. Quality over quantity, perhaps. A focus on sustainable, profitable growth.
Okay, and what about the premium figures? Annualized premium equivalent, APE.
APE overall was down 5% year on year. That's 18.64 billion. And the retail APE component was down a bit more, 9.2% at 15.12 billion.
Following that V&B trend then.
Yes, but it's important to add context. While it's down year on year against that very high base, if you look at the 2-year compound annual growth rate, the 2-year CAGR, it's still robust. Around 13% for both total and retail APE.
Oh, okay. So the longer-term trend still looks positive.
Exactly. And the total premium collected, not just the annualized new business equivalent, actually grew. It was up 8.1% year on year to nearly 90 billion.
Got it. So underlying strength, despite the dip in new business momentum against a tough comp, let's dive deeper into that product mix shift. You mentioned linked business declining.
Yeah, linked APE was down 13.6% compared to Q1 last year. It now makes up about 46.8% of their total APE, less than half.
And non-linked savings.
That was the counter story, grew strongly, up 20.8% year on year. Its contribution to APE jumped to 21.5%.
So that really shows the swing towards guarantees and away from market link, doesn't it?
It really does. Wealth preservation becoming key for customers. And for you listening, that's probably a key takeaway, watching how consumer needs change with market sentiment. It affects the whole financial services space.
Definitely something to track. And protection, you said that was strong.
Very much so. Protection APE grew 15.2% overall, contributing nearly 22% of the total APE mix.
15% growth in protection is solid.
And the retail protection part was even stronger, up 24% year on year. So real momentum there in individual life cover sales.
Okay. What about annuities? That was a big factor last year.
Yeah, that's a sharp decline, down 53.3%. But again, that's almost entirely due to that incredibly high base from Q1 FY 2025 when they had that specific popular product.
Right, the base effect again. Anything interesting within the annuity segment, though?
Well, they noted an increasing shift towards single premium annuity products.
Paying one lump sum for a guaranteed income stream.
Exactly, and they suggested this was partly being driven by falling fixed deposit rates, people looking for alternative sources of guaranteed income.
Makes sense, searching for yield and security. Did they launch anything new to cater to these shifting demands?
They did. They mentioned 2 key launches, one called Smart Insurance Plan Pluses.
Okay, what's that?
It's a linked plan, but designed to be very affordable. Aimed at wealth creation, minimum premium, apparently just 1,000 euro a month. So trying to make linked investing more accessible.
Interesting. And the other one?
I Protect Smart Pluses. This is a protection plan, a term plan, but it has some added flexibility features.
Like what?
Things like offering a premium break option, letting you convert it to a limited premium payment term later, and, importantly, offering an immediate death benefit payout upon claim registration, not just approval.
Oh, that last one sounds significant. Getting money to the family faster in a tough time.
Exactly. Addressing immediate liquidity needs. It shows a focus on customer pain points.
And all this activity, particularly in protection, how did it impact the overall sum assured? The amount of life cover they're providing?
Big jump there. New business sum assured, NBSA, grew by over 36% year on year, reached about 3.7 trillion.
Wow, that's a huge number.
It really is. And their total in-force sum assured all the policies they manage grew 17.1% to over 41 trillion.
41 trillion. It really underscores the scale and responsibility of a major life insurer, doesn't it?
Absolutely. Huge numbers.
Okay, let's shift gears a bit. Beyond products and premiums, what about operational performance? Efficiency, risk, customer service.
Yeah, they highlighted significant improvements in cost efficiency. Their overall cost-to-premium ratio improved by 280 basis points.
2.8 percentage points. That's quite a drop.
It is. Down to 21.2% in Q1. And specifically for the savings business line, the cost ratio improved by 270 basis points, down to 14.1%.
So they're becoming much more efficient at running the business, getting more bang for their buck.
That's the message, attributed to various cost optimization initiatives really paying off, getting leaner.
Efficiency is great, but in insurance, risk management is paramount. How do they look there?
They emphasized a robust framework, talked about focusing on right selling, right sourcing, and right onboarding, getting the right customers with the right products from the start.
And solvency, their capital buffer.
Very strong. Solvency ratio stood at 212.3%.
Way above the required 150%.
Comfortably above, yes, over double the regulatory minimum. And they also made a point of mentioning they've maintained 0 non-performing assets, 0 NPAs since the company started. Suggests a very clean, high-quality investment book backing those policies.
That 0 NPA record is impressive.
Mm-hmm.
Shows discipline. Okay, what about the customer experience side? claims, policy issuance.
They reported a leading claim settlement ratio, 99.6%. That's very high.
Almost perfect.
And maybe even more impressively, the average turnaround time for non-investigated individual death claims was just 1.1 days.
Just over a day. That's incredibly fast for a life insurance claim.
It really is. Shows a strong focus on getting payments out quickly when they're needed most.
Any other customer service highlights? Policy issuance speed.
Yeah, they mentioned 54% of savings policies were issued on the same day they were applied for.
Over half, same-day issuance. That points to heavy use of technology, I assume.
Absolutely. They're leveraging digital tools quite extensively. Mentioned around 53% of policies use digital KYC.
Know your customer checks done electronically.
Right, and they're using AI and machine learning for things like underwriting risk assessment and fraud detection. Plus, getting customers to use self-service options, 96.8% of service interactions are apparently now through digital or self-help modes.
Wow, nearly 97%.
Yeah.
So fewer calls to the call center, more app usage, and website interactions.
Seems like it. Streamlining service delivery.
How does all this tech and presumably better customer experience translate into loyalty? What about persistency rates? Customers sticking around.
Okay, so the 13-month persistency rate, customers paying their second year's premium, stood at 86.0%.
86%. How does that compare?
It's actually a slight dip from 89.7% the previous year.
Oh, why the decline?
They explained it as a kind of normalization. Apparently, persistency was unusually high the year before, partly due to some tax regulation changes that incentivized people to hold on to policies.
So maybe last year was artificially inflated, and this is a return to a more typical, though still healthy level.
That's the explanation given. And the longer-term persistency, the 49-month rate, stood at 69.8%. Nearly 70% of customers still paying premiums after 4 years. Which is pretty good.
Okay, so strong operations, strong customer focus.
Yeah.
Anything else on the operational front, like sustainability or ESG?
Yes, they did touch on that. Highlighted their commitment to ESG, environmental, social, and governance factors. They have an AA rating from MSCI for ESG performance.
That's a high rating.
It is. Positions them as one of the top-rated life insurers in India on that front. And they mention a tangible environmental step. 59 of their offices now run on renewable energy.
Good to see concrete actions, not just statements.
Yeah.
Okay, let's move to how they actually sell these policies, the distribution network.
Right. They emphasize the strength of having a very diversified network. It's not just one channel.
What does it look like?
Over 240,000 agents. A huge agency force. Plus, 49 bank partnerships, giving them access to over 23,500 bank branches across India.
That's massive reach through bank assurance.
Huge. And then also 1,350 non-bank partnerships. Brokers, corporate agents, web aggregators, that sort of thing.
So a multi-pronged approach.
Yeah.
How did these different channels actually perform in Q1?
Well, their own channels, what they call proprietary channels, so agents and direct sales, actually saw a decline in APE, down 18.1% year on year.
18%. That's quite significant. Why?
Again, primarily linked to that high annuity base from last year, which was heavily sold through the agency channel, and also the general shift away from linked products, which agents had been strong in previously.
So those channels were hit hardest by the specific conditions of Q1.
It seems so. They contributed about 38.5% of total APE, but the company did note that these channels showed agility in pivoting towards selling more non-linked products instead.
Adapting. Okay, what about bank assurance? Sales through partner banks.
That saw a smaller decline, down 2.1% year on year. It contributed just under 30% of the APE mix, also impacted somewhat by the slowdown in unit-linked sales, which banks often focus on.
And the other partnerships, non-bank ones.
They actually grew. Partnership distribution APE was up 6.6%, contributing about 13% of the total.
Okay, some growth there. And group business, selling to companies for their employees.
That was a strong point. Grew strongly by 18.9%, also contributing around 13% to the APE mix.
So a mixed picture across channels,
Yeah.
really highlighting the benefit of not relying on just one, wouldn't you say?
Absolutely. Diversification helps cushion the blows when one particular channel or product type faces headwinds.
And what's their strategy for distribution going forward?
They said they'll continue to invest heavily in their proprietary channels, especially agency, and also focus on deepening their reach into smaller towns and micro markets.
Expanding beyond the big cities.
Right. The idea is that building this deep, wide, resilient network will allow them to achieve sustainable growth no matter what the market environment throws at them. Flexing with the market.
Makes sense. Building for the long haul. Okay, let's zoom out now and talk about the future. What are the big opportunities they see in the Indian market?
Well, the first one is demographics. India has this huge, young, and growing working age population, people aged 25 to 59.
The prime earning years.
Exactly. And that segment is projected to grow significantly over the next decade, out to FY 2034. That creates a naturally expanding pool of potential customers for insurance and savings products.
A demographic tailwind. What else?
The ongoing financialization of savings. We're seeing Indian households steadily putting more of their savings into financial assets rather than, say, physical assets like gold or real estate.
Moving money into the formal financial system.
Right. Financial assets reached 64% of household savings in FY 2024, up quite a bit from FY 2014. And within that, life insurance makes up a significant chunk, about 17% of those financial savings. So as the pie grows, insurance gets a good slice.
Okay, favorable demographics, more money flowing into financial products. What about unmet needs? Gaps in the market?
A huge one is the protection gap, the difference between the amount of life cover people need and the amount they actually have.
How big is that gap in India?
Estimated at a massive $16.5 trillion back in FY 2020, and coverage levels are still quite low. Only about 13% of the addressable population had individual protection policies, much lower than many other countries.
So a massive runway for growth just in basic life
A
insurance.
huge potential, yes. Just covering that existing gap represents a major opportunity.
Any other major opportunities?
Retirement is another big one. India's pension system is still relatively underdeveloped. Pension assets are only about 6.9% of GDP.
Very low compared to developed nations.
Very low. And at the same time, the population is aging. The segment of older people is growing faster than the overall population, so you have this growing need for retirement income solutions.
And not enough formal provision currently.
Exactly. And life insurers are uniquely positioned here because they are the only ones allowed to sell annuity products, those guaranteed income streams for life.
So they have an exclusive on a key retirement solution. That's a strategic advantage.
Definitely. So management sees these big trends, demographics, financialization, the protection gap, the retirement need, as major tailwinds.
And their strategy is designed to capture these.
That's the plan. They reiterate their focus on what they call their strategic building blocks: product leadership, that extensive distribution network we discussed, and operational or business excellence.
The foundations.
Right. And all supported by investments in their people, ongoing digitalization, and using data analytics more effectively. The goal is clear: drive sustainable VNB growth over the long term by tapping into these market opportunities.
Okay, quite a journey through that quarter.
Yeah.
So to sort of wrap it up, we've seen how a major player like ICICI Prudential is navigating what was a pretty challenging market in Q1
Yeah, adapting the product mix, really tightening the belt on costs, focusing on efficiency.
while doubling down on customer service, especially things like claim speed, and all the while keeping an eye on those big long-term growth drivers in India.
It really paints a picture of resilience, I'd say, and strategic adaptation, balancing short-term pressures with that longer-term vision.
It's like they're playing both defense and offense at the same time, managing the current market but setting up for future wins.
That's a good way to put it.
So here's something to leave you with, the final thought. As we see customer preferences shifting so much, and technologies, particularly digital tech, evolving so fast, how might the fundamental idea of insurance change in the future? What new risks, what new needs will emerge that today's insurers aren't even thinking about yet? What innovations might be on the horizon that go way beyond the traditional policy structures we see today?
That's a fascinating question. What does insurance look like in 10, 20 years?
Exactly. Something for you to ponder. Thanks for joining us on The Deep Dive.